Hello, everybody. It's great to see you again. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors, and welcome back for another Cup of Joe for the 2 weeks ending Friday, July 29th. So it was a very good 2 weeks for the stock market. The S&P 500 was up just under 7% for the past 10 trading days. Real estate stocks and large growth stocks, which include a lot of tech names, those were up a little over 8% for that 2 week span. So a lot of market recovery happening in the month of July, which is excellent to see. And for good measure, I'll let you know that bonds also recovered about 1.8% in that time period as well. So also nice to see. So last week saw the utilities sector turn positive for the year-to-date measure. So that now makes two sectors in the black for 2022, which is great. Energy has been leading the way, obviously, because energy prices have been high, and that's boosted the stocks in that sector. And now utilities. Stocks in the utilities sector tend to perform well when there's a lot of economic and stock market uncertainty. Mostly because the revenue streams of those names are relatively stable, and most of those stocks pay some pretty nice dividends. So investors flock to that sector for some stable income in times of volatility. Now, the big news out of last week was that US GDP contracted for the second straight quarter. And 2 consecutive quarters of GDP contraction is commonly accepted as the most basic definition of a recession, but that's not actually the case. So let's talk about recession for a minute. The official decision on a recession is made by a 8 to 12 person panel at the National Bureau of Economic Research. And while GDP contraction is one thing they look at, they consider many other data points when formulating a decision on whether the US has had or is having a economic recession. Now, typically in a recession, you're going to see other factors such as rising unemployment, which usually leads to a slowdown in consumer spending, and you see industrial activity slow significantly. And we're just not seeing that right now. There's still a lot of demand in the labor market for workers, which we hear about often. Consumer spending is still quite strong. And leading indicators of economic activity, which have been published in the past couple of weeks, have been surprisingly positive. And that was evidenced in the stock market from last week, with the industrial sector being up about 5.7%. So because of all this mixed data, among economists and research analysts, there's really no consensus on whether a recession is definitely going to happen or not. While there's still a significant chance of a full recession materializing, if some of the data we just mentioned starts to weaken, a recession is by no means automatic, even though there's been 2 consecutive quarters of contraction. So with that, I'm going to end with a little tongue-in-cheek anecdote that made me smile. This past week, I read of a financial writer who coined the term vibe session. By that, they're meaning that everyone's walking and talking with the recession vibe. And it's just this general gloominess about everything, even though we are not in a recession, and a recession may still be avoided. So I think it's fair to blame that one on crazy inflation and high prices. So we hope you found this Cup of Joe useful and insightful. If you have any questions about anything we've talked about or any other topics, please feel free to reach out to us, and we will talk to everyone later.